Hello, my name is Roy Wetter with Good, Bad, and Ugly Real Estate. I'm bringing you here today for taxes. Taxes. Now, before I actually do this video, first thing, I'm not a professional, and I, am not licensed in any way in this. I'm just a real estate investor that's owned properties, and now I, run a real estate investment group where my main goal and focus, and I want to bring this to you and make sure this is clear to you, my main goal and focus is to take the gap that is ensuing and continually widening between the middle class, lower middle class, and the upper class, and I want to start shrinking that gap. And the reason I want to do that is that just in general, it's been a historical fact that over the centuries, the widening of the gap between the lower middle class or the lower class and the upper class has caused the downfall of many, many countries. And I think it's one of the biggest ways we can really bring ourselves back into an amazing state in this world, in the US. So that is my goal. My goal isn't to skip out on taxes. My goal isn't to cheat the system. My goal isn't to teach anyone how to be super wealthy so that they don't have to pay taxes and they can live with the elite. My goal is to bring knowledge and facts to people in the modern lower middle class, upper middle class to help build themselves up to a greater state in this world and to make a difference in that way. So that being said, this is a show that really explains to you down in depth every little piece that I know how to get every single one of those tax breaks and those tax secrets or the tax incentives that only the wealthy have the opportunity to get, which is absolutely not true. And I want to bring it to you, and I want to show you exactly how the wealthy people don't pay any taxes or very little taxes, which in itself is not true. And you're going to find out that later on in this video, but you're also going to find out exactly how to get all those tax incentives and breaks for yourself, or as many as I can bring to you anyways. A few that I don't mention are like charities and stuff, but there's more than what I have here, but I really have a large majority of everything that you've ever thought the tax on the wealthy and the rich, the way they got away without paying any taxes. It's all here in this video, and we're going to get to it right now. Alrighty, so here it is. This is the 1040 form in your actual tax file. This is one of the forms that if you own rental real estate, this is where those numbers are going to be placed when it gets turned into the government from your CPA. So everything that you give him in paperwork, he puts into this form for your real estate, and that's what gets turned into the CPA. Before we get into exactly what I give to the CPA in order to work my taxes correctly, I gotta have you guys understand this, because this is one of the primary ways in which rich and wealthy people actually pay taxes in other means other than their personal bank account. And so if you could imagine every real estate property that's own personal small business, so let's say someone that's wealthy or rich has 50 or 60 homes. And how can he do that? Well, because he's worked his life, living a life in this way in which he has actually learned and studied tax code and learned and studied small business. He's put in the time and the work. And before you give me crap about, he was just born wealthy, 80% of millionaires in America today were 100% self-made millionaires. Started out with almost nothing, 80%. And that's actually only 90% of the billionaires in the world today were self-made billionaires. So, boom, a little bit of a myth destroyed right there. So, rents received, right? $9,422. This is one of my properties last year that I claimed on taxes. $9,422, right? So, what they said is, hey, yes, you made that much money, good. But you know what? The government's not super unfair. I know it doesn't seem like it all the time. I'm not a huge fan, but at the same time, tax-wise, I'm not too upset about it, all right? They say, hey, okay, this is how much you made, yes. We're not going to charge you for this amount, though, because it cost you so much money to make that money. So how much did it cost you to make that money? Well, you made this much money, but it cost you $1,200 in insurance that year. It also cost you $800 in management fees. It cost you mortgage interest paid to the banks, so the interest on your loan, $2,618. Repairs that you made that year on the property, that's $1,450. $825 you paid in property taxes. Well, that's not the property you're living in. Do you really have to pay property taxes on something somebody else is living in? Well, the government says, yeah, that can be an expense. Go ahead and write that off your taxes. So you can. Right here, here's the money maker right here, right? So you might have put in so much money to repair the property. You might have put in so much money to repair the property, and get it fixed up, get it ready to rent. Also, when you purchase the property, the government's going to let you actually deduct that entire amount. So this specific property you paid $80,000 for, we're going to be able to deduct that $80,000 over the course of 30 years. And the way they do that is because it wouldn't really help you out to deduct $80,000 out of your taxes in the first year, because then you would just be sitting at a negative income of like $68,000, and the government's not going to give you that amount back. They only give you back what you didn't have to pay in, or what you did pay in that you shouldn't have paid in. So they have to do is they help you out with that. They split it up amongst 30 years of paying of paying on that mortgage, or that mortgage. They split it up for 30 years. So that adds up to a depreciation of $3,199. That's the money maker, because that's the money that the mortgage from the bank is actually holding. The interest is deductible, and the people that are renting your property are paying you the money. You're paying the mortgage down, so you're actually not paying this money. It's coming back to you. And actually, my real net income off this property was about $3,900, which is pretty darn close to this depreciation amount. I will say I didn't work on this property or actually fix it up, so there's a lot of things missing on this property that I would normally have. Also counting against my income in a good way. So they deemed that this property made me a gross income of negative $1,274. But in all reality, because the bank loaned me the money, and the bank charges less money than I would have to pay for the property myself, and because the renters are paying me the money and I'm paying it straight to the mortgage, I actually made $3,900. But the government doesn't look at it that way. They see you as still losing money because your value of your property is depreciating over years. Now, that's not necessarily true, because as we know, value of properties appreciate. And they appreciate. For the most part, they've been appreciating for the last 15 years. And so it's not cheating. It's not cheating on your taxes. It's not a special break. It's just a simple fact that the government says, no, what you own isn't worth that much. And you say, okay, well, I made this much. And they're like, well, you don't have to pay taxes because you really didn't make that much. And you can say, well, it's in my wallet right here, government. And they're like, they don't want it. All right. And that is one of the main ways that rich and wealthy people know to do their taxes. They buy property, they do it this way. There's also different ways through small business, which I will get into later on in the video. Hello, my name is Roy Wetter, and this is the Good, Bad, and the Ugly show. This isn't an episode. This is just an informative video on how to do your taxes when investing in real estate. So there's a lot of people that come up with questions, and they say, hey, I hear that you don't have to pay taxes when you're doing real estate, when you're working in real estate. Or if you do your taxes right when you're working in real estate, there's no taxes. You're not going to pay anything at the end of the year. And that's not necessarily true. It is a lot of times true, but not in the way that it's being worded. What happens is that you have a lot of different things in your real estate when dealing in real estate that are going to depreciate and be able to deduct, because you're going to have to be able to put a lot of money out in order to be making money with this real estate. And so the government looks at it and says, hey, you fixed up these properties, you did a really good job, you're renting them out, we appreciate you bringing up the value of the economy and of real estate, and we have a lot of incentives and deductions and depreciation that you can have on your property plus. So we're going to go over all that today. I'm going to go through exactly what I claim on real estate. I am not a real estate professional. First off, I'm not a tax professional. I'm not a CPA. I'm not anything to do with, I have no licensure in this area. I'm a real estate investor, and I have studied a lot of this information having to do specifically with Oklahoma. So that's another disclaimer there, that if you live in a different state, it's going to be different for you. Some of this information is state dependent, so it's not always going to be the same thing. But yeah, I studied this pretty extensively, and I believe that I'm doing everything I can in order to work my taxes correctly. I'm not working the system. There's no special sauce. A lot of times when they say, that, the wealthy, they have this much higher means of, there's this extra tax, breaks for the wealthy. A lot of those extra tax breaks that people are talking about are really just tax breaks and ways of working your taxes that almost anyone could do if they, one, figure out a way to have a little bit of real estate, and then two, open up a small business. A lot of the wealthy tax breaks are really just tax breaks and incentives, and they're not even really tax breaks. They're really just ways of putting your money back into yourself in order not to have to cost money, or put money back into your business so you don't have to actually pay taxes on that same money. Anybody can do this. You want to start up a business, selling clothes hangers to your local, thrift shop store, then you can actually use that to put your money in different places in order not to pay as much taxes on what you've earned that year. If you want to own some real estate, you can invest more in your real estate, which brings you more every year, which then entails, you don't have to actually pay taxes on that. So there you go. That's a lot of the wealthy's tax breaks that aren't available to the lower class, which, just if you guys don't know, I am the middle class. I would be considered technically on the scale lower middle class, middle class, not upper middle class by any means. I am technically retired. I don't have to work anymore. I own real estate, and those are amazing things. I get to do with my day every day what I want to do with my day, but I'm not a rich person by any means at this point in time. But I do know how to do my taxes, and I take advantage of almost all the tax breaks and incentives and different things that I can do through taxes. And I'm not wealthy. I'm not rich. So I'm going to actually hopefully show you how to do that today with real estate. All right, so the first thing we're going to go over to is my folder system here. So I use Word, Excel, stuff like that. It costs me, $12 a month to have this system, to have a business standard system, so that you can actually use this. This is the file system that I use. It's taken me quite a bit of time to actually set up a file system to run this whole business. But we won't get into that today. We're just going to get into taxes specifically. So we'll go into the taxes specifically. Oh, now you can see what I'm doing. Go to taxes. All right. Now, within the taxes folders, I have the different properties. We're not going to do that quite yet. We're going to go, I'll talk about that. So I have different folder systems for different properties. I have 1 property, 2 property, 3 property, 4 property, and then we have things like exempt folder. Oh, that's just, that's nothing. That's to set up the next properties for a folder. Home office expenses, information. So that's what we're going to be sending to the CPA when we get done with everything and we actually calculate everything else, and I'll show you guys that too. LLC expenses, materials and receipts, medical costs, because personally, most of my properties are within my own name currently, so that means that I can use medical costs and stuff like that. If you go to the doctors, you can claim the mileage to the doctor's office and back. You can claim the actual cost of the doctor visit against your taxes. So what that means is it's not depreciation. It's a deductible. So what you made that year, let's say you made, I'm actually going to go over to my display here, and we are going to pull up a calculator and do it this way. So let's say that you made $50,000 that year, and you went to this doctor's office. It was $100, and now you can claim that against your income. So what that means is that if you made $50,000 that year, you were going to say, okay, but I drove 50 miles to this doctor's appointment. 50 miles is a little stretching a little bit. I drove 10 miles into town, went to this doctor's office, drove 10 miles back. So that's 20 miles. They calculated it as a certain cent per mile. So what you need to do is you need to track the miles that you drove for your doctor's visit. So you're going to say, I drove 20 miles, so that's 20. Whoops. Back. That is 20. Nope. That is, we'll just say 58 cents. 58 cents times 20 miles equals $11.60. So you take that $11. So you're going to give them miles to your CPA, and you're also going to give the receipt, or not technically a receipt, but the amount that you paid for that doctor's visit. It was $100, $300, $400. Now, let's say it was $400, so you're going to plus 400. Now that $411 is going to come off of your income that year. So the government's going to say, okay, if you made $50,000, but medically you had to come up with 400, minus 411. I can't remember. What was it? 60. $411.60 you had to pay for medical. We're not actually going to charge you in taxes for what you had to put out for medical, because that's not really what we want to do. And so now we're going to look at it as if you only made $49,588. Now you can do this with all your medical expenses. Not guaranteed. Every state's different. Federal government's the same, but states are different, and the ways in which you can do this are different. Anyways, so you can do this with all your medical expenses. If you really want to look at it in a weird way, look at it this way. The government's going to charge you taxes. This is the way I try to look at it, so I can realize everything that I don't have to pay taxes on. The government will allow you to depreciate almost anything that you can that does not involve you enjoying it. So that's the way I kind of look at it, right? If I'm buying something that I'm going to enjoy, use for my personal benefit, then yes, you'll pay taxes on that. You're going to pay taxes on a car. You're going to pay taxes on the boat. You're going to pay taxes on your new gun. You're going to pay taxes on paints that you want to, right? So it's not about the income you make. It's about the output. The government wants to charge you taxes on your output. So if I'm buying all these play toys and these things that I enjoy using, then the government is going to charge me tax on that. That's why a lot of times the government doesn't charge you tax on food or eating out at dinner, because those are things you need as a necessity of life. The government doesn't charge you tax on your medical bills. The government doesn't charge you tax on money you put back into real estate or the money you put back into your business, because even though you made that money, you didn't technically hold on to it. It had to go back somewhere in order to grow your business larger. The government doesn't want to charge you tax on that. They charge you tax on your net holdings. So I'm not saying that you can deduct absolutely everything that you don't enjoy, but I like to look at it as if I almost could deduct anything on stuff I don't enjoy. That way I can see everything that I can deduct, hopefully. Run it by your CPA. Don't just assume you can deduct something and deduct it. Study it, look it up, run it by your CPA. Everything I'm giving you is just a look into how you might be able to do this. All right, now we're going to get back into real estate. I'm going to pull up what I call my tax summary for this year. Now, I blacked out certain information such as my family, their birth dates, their social security numbers, and some footnotes that have personal information in it. But other than that, it's all here, it's all raw. This is exactly what I'm sending to my CPA in the year of 2021. Now, this information that's here, if it is not correct, if there's some numbers that aren't things that I can deduct or aren't things that I can, then I'll talk with my CPA about it. Very smart man. and we will go over what I can deduct, can't deduct, why, and where, and how, right? But this is what I'm collecting to send to my CPA, and I've been doing this for a couple years, so I've got it pretty fine-tuned. But this is what I'm sending to my CPA for him to look over and pretty much do what he does with. Now, CPAs, you got to think about it this way too. CPAs are there to, yes, they put your taxes together. But they're not going to do all the groundwork. And some of them don't want to do all the groundwork. A lot of times people will take their taxes to the CPA and they'll say, hey, I have this pile of papers here, and they'll drop it on the desk of the CPA, and the CPA will look at it and say, what is that? Right? I remember the first year I had a couple rental properties, and I sent my CPA every receipt. I sent him every receipt, every document on every property, all my medical bills, all my everything, and he said, I don't need any of this. I just need your overall numbers. But this is the thing. CPAs aren't there to say, all right, this person's not lying. This person's telling the truth. The CPA is there to take your numbers, put them into the system the way they're supposed to be put into the system to get the tax, so you pay the taxes you're supposed to pay based on your merit and your truth telling. You can tell the CPA anything you want to say, and then it's going to come back on you if they do an audit on you and they find that these things aren't true. So you have to be able to give them, the CPA, this documentation, but if you get audited, you have to be able to prove the documentation, and that's where they're going to come back to you and look for the receipts, and that's why you have to track this stuff meticulously, and we'll get into that in just a little bit as well. So first thing we're going to get into is personal income, right? So I am retired military, as you can see on this screen. W-2, so I have a W-2 from earlier this year because I'm only just recently retired. Insurance coverage, proof of insurance. So I have insurance through the government, and I'm going to be sending that as proof so that they don't charge me for that insurance. Because once again, like we said, the government doesn't actually want to charge you for medical things that you have going on. 1095C, that's I think just more medical things. So I had weird things, right? Like insurance coverage proof, right? So they're not going to charge you for that. But I have medical insurance, and I have two 1095Cs. Do I know why there's two, but there's two sets of different numbers? No. So I'm including that in the paperwork that I'm sending to my CPA. He can divulge that, figure it out, and tell me why, right? So what I'll show you guys too before we get too into depth with this is go back to my folders, and what you're going to see here is we're going to go up to what I'm sending to the CPA, right? And as you'll see here, what I'm sending to the CPA is I'm sending the that one document that we're just looking at just now, but I'm also sending different PDF files that we'll get into. But what I did is I color coded it just to be nice to your CPA, try to give them a little bit of a leg up on all this paperwork and documentation. Don't be the guy that drops everything on his desk. He might not be as meticulous with your information. You know, these people work just as well as anyone else works. And if you come and you drop all that material on their desk and say, here you go, figure out my taxes, he might put a ton of work into that and say, you know what, I'm just punching these numbers in and I don't really care if I missed a couple receipts. So try not to treat them like that. I color coded it, the information in the Word document. And then what I did was I linked it for that color to the PDF. So I'm looking for personal information, or I told him, you know, personal information found in this PDF green. At this right down here, it says green, W2, green. There might be a better way of doing this. If there is, then let me know. Maybe you got some secrets that I don't have going on. My W2 travel miscellaneous, green. My medical insurance proof, green. And then as we get into the different properties, each property has also a color code, and that's going to be gray, light blue, purple, yellow. Just helps the CPA get along through the information better. All right, now we'll go back to the tax summary. So that's where we have our personal information. As we go down, we're going to have business operating costs. So the item is on the left, as you can see here, and the cost is on the right. So work phone receipts. If you're using your phone for 80% or more, at least within the state of Oklahoma or federal, I don't know, whatever. Anyway, your phone bills can be deductible, right? Here's the thing. I've studied this stuff for hours and hours and days and days. This was my life in studying for like 5 months. It's all I did was study tax. But I studied it so I could get all this in line the way I knew I needed to get it in line, but I don't need to be the expert on it continuously because I have a CPA. So let's say phone receipts. I collect up the phone receipts, I send it to the CPA, and he's like, you know what, I don't think you can claim this because you weren't using your phone for work like you say you were. Or now the state has has put out a new regulation that says that you have to have a work phone and a civilian phone in order to claim the work phone, right? Things change, things update. This is a basic overview of what I'm claiming currently, or what I'm sending to my CPA to claim. And he can help me out and change these things up. So currently, work phones, right? Mileage driven for work. So I drove 4,368 miles this year. The current rate at which they will give you a discount is, I think it's 58 cents per mile. So if you drove mileage for work, 58 cents per mile that you drove that year. Now that's not to and from work, but that is work that miles you drove while you were currently at work. So like for me, if I was out looking for properties, if I was going from property to property with my property manager, if I was working on a property and I was going back and forth to Lowe's, to the store, to Harbor Freight, all that is deductible mileage, and it's a huge deduction. It's a huge deduction. 58 cents per mile deductible currently, which means that this right here will get me written off of my taxes 2,000 some miles, right? And so, or 2,000 some dollars or something like that. So the thing is, you know, you might not want to track your miles. If you don't want to, fine. So what I use is I use something called, what is it called? It's a Word, it's a Microsoft product, and it comes with my business account, my Microsoft business account, and it is called Mileage IQ. So you can look up the little app, it's called Mileage IQ. You can pay for it without having Microsoft business account, but it comes with my Microsoft business account. And how it works is, I pull it up, it consistently tracks every mile I've ever driven, or the miles in which I drive while holding my phone through your phone. And then you pull it up, you look at it, and it will say, hey, you went from A to B. And it will say, was this for work or was this personal? And you swipe left for personal, right for work. It's that easy. So at the end of the week, I'm chilling I'm watching, you know, a movie or something like that, and I say, oh, I should do my miles. I pull up my phone, swipe left for personal, right for work, and I just boop, 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 boop. You can name locations so that you have an easier time distinguishing whether you did it for personal or work. And you know, it took me a little while, but I named pretty much every location in town because I'm kind of an overachiever like that. And so now I know every single location I go and come from. It takes me 2 seconds to wipe out a week's worth of driving like that. And so I can track all my miles, and it sends you a chart, which I can show you. It sends you a beautiful little chart every month, and it also sends you a beautiful little chart, and it also sends you every year the end of your year mileage, where you went. Also medical mileage, it tracks medical mileage too. So you can go personal, hold it, and then you can click medical miles, and it'll do that for if you went for. So now you're tracking your medical miles, now you're tracking your real estate miles. Beautiful. If you get a vehicle for real estate, and you want to track the mileage that your vehicle's driving with your employees for work, then you can do that as well. We're going to go down here to vehicle mileage. There we go. Mileage IQ, basic log information. We'll do that. Hopefully there's no personal information on here. Here we go. All right, I got to expand this a little bit. I will show you guys in just a minito. Column width, do 25. All right, display, there it is. All right, so we have our odometer here. Man, it doesn't make sense. Business. So we come down here. These are the 2 sets of mileage we drove for business. So you can do different vehicles. So if you have a work car, I only do one vehicle because I only have one vehicle right now. You have a work car, you can do that vehicle here. You have a personal car that you use for work, you can do that vehicle here. It gives you the total. You add these together and that's your mileage for work. Commute, personal. These are my mileage I drove for my personal miles. I'm gonna scroll this over here. I didn't drive that many miles for medical, just so you know. All right, so here we go. So we have here you go, here's your medical miles, and here is your business miles. All right, I think that's enough on mileage. Go back to tax. All right, so we're gonna move on. Driven for medical, there we go. Total purchase for work. So I purchased this year $4,397 worth of tools. These tools I use because we have a small contracting business that we are starting up, as well as the real estate that I do. I purchase properties, we fix them up, and we turn them into rental properties. And so therefore I need a lot of tools. And so I've spent $4,397 in tools. That money will be taken away from the overall cost, or will taken away from the profits that I use. Now, do I still have the tool? Yes. Does this tool still hold value? Yes. But do I have to pay for that in taxes? It's going to be deducted, because those are the niches. That's the rich, the wealthy's, way of getting out of taxes. They purchase something for the business, it comes out of their pocket, so the government doesn't charge them for that because it's going back into a business. All right, so that's how much I paid for that. I'll go into the receipts just to show you real quick how that looks like. This is the calculated amount, but if we go back to here, we can look at what it looks like in the receipts. All right, we're going to go into tools. We're going to go into my tools. And here we go. So this is how I log my tools throughout the year. With Microsoft, I feel like I'm a Microsoft rep. With Microsoft, they allow you to log receipts and all this other stuff and place it into file folders. Believe me, it's a little bit to get used to. Microsoft is a lot. But once you get it down, you can use it for your business. You can pay other programs to do similar things, and they're simple programs, and they're not nearly the learning curve as Microsoft was for me. But it's not as... a lot of times they're not as, what am I trying to say? A lot of times they're not as conformable. You can't conform them to your business specifically. You kind of got to fit your business into their mold versus their mold to your business. Whereas Microsoft is very malleable. You can fit it to your business. Anyway, back to this. Lowe's. So we come in here. Boom, here's every receipt I've spent this year. So what I'll do is I'll collect all the receipts in a nifty little thing like this. This cost me a doll hair. It cost me a doll hair from the Dollar Tree. I am a very cheap man when I don't have to spend money. You put in here, you have the different properties, different receipts for different properties, different receipts for tools, and that is it. You put them in here. Now, I like to calculate the receipts as I go so that I can also, I like to upload the receipts as I go so that over the time I can just go to the month, go to the place I bought it, and I can find the receipt that I used to buy that product. Boom, there we go. So if I have to return a product to Lowe's, I can easily find it and take it back to Lowe's and get my money back, and which is fantastic. But that means I don't have to worry about trying to dig through this folder to find that receipt. All right, get ahead of myself there. Alrighty, so that's my receipts, right? We come out here. Oh, wrong screen. Sorry, guys. Sometimes it gets confusing on which screen I'm supposed to be clicking on. All right, there's the receipts. I add them all up from the different places that we bought tools from. It comes up here, I add it all up for that folder, and that's the number that I send to the CPA for the materials bought for the tools that year. All right, we'll come back to here, and we're gonna go back into our tax summary. Alrighty, so that's tools. Tools for work. Intellius. So Intellius is a website that I use to look up personal information on people because I'm a creeper. No, when in real estate, sometimes you find a property and it looks like it's out of disrepair, and you're trying to figure out who owns it so you can see if they're trying to sell it. Anyway, long story short, that was $237. DocuSign, which I use all the time, send out to people to have documents signed. They verify people, and then you can sign documents legally. I use that. Most agents around the country also use DocuSign, so it really works because it mingles well together. Adobe, I pay for that. Microsoft, $75 for the year, which is like crazy for what you get. Oklahoma County Records. So Oklahoma County Records is a county website where they charge you to look up documents on everything from work or from any legal things that have taken place. So whether the person's being foreclosed upon, whether they have somebody that's put a lien on their property, every single time somebody files a document involving real estate with the state, we can find that in our state, Oklahoma County Records. Upwork, Driving for Dollars app. I don't use that anymore. I tried it once. Work meetings and trips. Oh, here you go. Work meetings and trips. Any trip or any drive that you make, and let's say you're going down to, with me, I buy products from Wichita Surplus and Dirt Cheap all the time. Amazing places to shop for used items and not have to pay so much. We drive down to Wichita Falls. I spend all day shopping for materials and getting inventory, and maybe I have a meeting with somebody down there. All of that is tax deductible because it wasn't for your personal gain. You were doing this for the business. This was money you spent for the business. This is miles you drove for the business. Calculate it and keep all the receipts from the meals you had. The meals you ate for that day, since you had to eat those meals out for the business, are tax deductible. If you have a meeting with someone, you take someone to an office meeting, tax deductible. Now, this person could be as simple as your brother. Let's say your brother works with you, and he works with you on real estate, and he helps fix them up sometimes, and you want to talk to him about real estate, and you're like, hey, let's go talk about real estate. We'll go down to Popeyes and talk about real estate. So you bring some documents, you talk about real estate, boom, tax deductible. The meal was. Now, if you go, let's say you take and you have 3 or 4 employees, and you say, hey, this year was an amazing year. I want to take you all out to the Bahama Islands. There's a lot that you're going to do on that trip. As long as you're spending 80% of the time on that trip, I want to say it's 80%. Don't quote me on that. As long as you're spending a certain percentage of the time on that trip, learning about real estate, working in real estate, working on your business, that trip can be a lot of that trip can be tax deductible, as well as meals and maybe airfare and maybe stay. I'm not sure on the 100% gist of it, but just know that a lot of that is tax deductible. So these wealthy people, there you go. That's another one. The wealthy have all these tax breaks. No, the wealthy just deduct these trips. They're tax deductible. They're doing business on these trips. They go to France, and they meet up with some French people that they're selling product to or purchasing product from. They go out on the town. They eat dinner. They talk about it. Now that trip is tax deductible because it's a work trip. It's a business trip. And that's the same for your employees. If you're forcing them on a business trip, or if you're requiring them to go on a business trip, then they can deduct that on their taxes as well. And those are the wealthy tax breaks. They're not for the wealthy, for anybody. All right, we'll keep going through this. Business meetings, property search and acquisition costs. We're going to scroll down. Home office reimbursement. So I have a space within my house. It is an entire room. And it is specifically for my business. I have files in here. I have a table. I have... I sound so silly. I have a table. There's a desk. There's a camera. There's operating equipment. I make phone calls. This is my workspace. It's not... And so therefore the government says, hey, if you have a workspace that you're paying for that you don't really get to use for anything else, then you can deduct that on your taxes. So this is my house. This is where I live. My family lives all around me, but this location, this square in this room is my office. So my office is tax deductible. And what that means is I can deduct the office space. So you need the square footage of the space as of last year. You need the square footage, how much you would charge for rent, or how much do you charge yourself for rent to rent the room in your home. So what they use is I use a square footage to give a basic general rent estimate from the area on what other people are paying for square footage for rent. And there's your rent. Okay, I'll go a little more into depth with that. So if you're renting office space, if you go out into town and you want to rent an office building, they're going to tell you, okay, it's going to be this much to rent it. You can break that down into the square footage. So you want to rent a space that's, 100 by 100 square feet. They're going to charge you so much. You divide that into square footage. That's how you can get your general square footage cost of renting office space. So you look at what people are charging for office space on Zillow or on any other means of information like that. Maybe you call a couple places and say, hey, what do you charge for this rent space? How much square footage is? You gain the general square footage of that place, and then you're able to charge yourself rent, in effect. Because you have a business, you are you as a person with personal tax. Your business is your business, and if you are if you are working in that location, you can charge yourself rent. You can charge your business rent for working out of your house, and that's deductible. So what is deductible? The deductible is the rent, because it's overall business cost. Electric bill. So the bills, you can divide the bills for that year. So I have my electric and my gas throughout the year is so much, but I'm splitting it off as a percentage that I spend as business expense. And that's all doable. Now this gets a little into the weeds on what specifically is deductible based in your state and your laws. This is one more thing that I'm going to send to my CPA like I do every year, and he's going to tell me, you know what, Roy? They don't allow that anymore. The office space can't be in your home. Well, if that's the case, then we won't claim that on my taxes. But as of last year, this is all legally claimable. Like I said, not a tax professional. This is what I claim, giving you a good insight on what you're going to want to look into claiming next year. Or, this year for next time. Yeah, whatever. Alrighty, here we go. So I'm going into a workspace where I'm starting to use LLCs more than my personal self. So from now on, I'm purchasing all my properties through an LLC. I do commercial real estate loans now. So all of them will be purchased through LLCs. Now I'm going from personal business, which a lot of this, it's the same thing you've been seeing, but at the same time, like, I'm just converting it into an actual LLC now instead of a personal business. I do have the LLC. I will show you here. Where are you? There it is. Dragon Realty Investment Group. That is an LLC that I have. That's an actual group. It is, we have like 14 or 15 members. They're all investors into the group. They're part owners in the business. And so therefore I do this. I'm not doing this because it's fake. All right, it's real. All right, government, don't kill me. No, every single investor I have is also an owner in the business. So they're not technically an investor. They are putting money into the business that they own. So that's how I have investors. I have business owners. So when I say investors, that's a miscommunication or misnomer. Is that the word? I don't know. They're actually part owners in my business, and that's how I work with investors. So they own part of the business in Dragon Realty Investment Group. Legal fees. It cost me $945 to start up this LLC that I haven't quite used yet. Down here, I have an LLC that I've had for a while, Consortium of Ancients LLC. If you guys have ever seen Boss Baby, the cartoon, you would know what that is. So we have this LLC, and this is the LLC that I actually personally own 100%. Therefore, it's not really seen as a business. If you own an LLC that is solely owned by you, it's seen as a sole owner business, which just means it's you. The government's going to look at it and say, that's just you. That's not quite a business. Come on. Don't lie. It's kind of just you. But as far as this group goes, this would be 100% of business. So all of this down here does not technically really help you tax-wise, owning an LLC that's just 100% occupied by you. But I use that as my contracting business because I don't want anyone else to really have my contracting business. But the people that I work with in real estate, I want them, they own a part of the real estate, they own a part of the business that generates income. But this, let's say, anyways, long story short, you can deduct the legal fees and, where is that? Oh yeah, you can deduct legal fees as a business. And I'm actually going to come over to this folder, go back to here, and here's the home office expenses. We'll look at this real quick. Here's all my different bills in which I hold for those home office expenses. Thank you. And DocuSign. All right, cool. That's that, as you guys can see. I come down here further, the information I'm sending. LLC expenses. Here we go. Consortium of Ancients. Nothing. I don't have any expenses for that this year. I really didn't use it. Dragon Realty Investment Group. Here it is. Here's my receipt. Actually, I don't know what's on there. So I can't really show that. But that's my receipt for setting up my LLC. You really don't need to see it, but my receipt for setting up my LLC is right there. So any expenses that your business incurs are tax deductible. All right, we're gonna go back to tax summary. This is gonna be a long video, but it's well worth it to get almost everything you need for your taxes next year if you're trying to do a small real estate business. It really is. I've never been able to find something this in depth anywhere on the internet. I had to put this all together myself. There we go. All right, we're back. So, home office expenses, legal fees, also another thing deductible. Okay, so anyway, here's my primary residence. So I have primary residence because when you're working in real estate, even if you're fixing up your primary residence to be a property in which you rent out, it doesn't really turn into an investment property until you start renting it out, even if those are your intentions. Just so you know that. It has to do with taxes. Primary residence, now you know where I live. Like I said, these are color-coded because these actually have PDFs attached, and we'll go into that. So material improvements on property. Don't have any right now because I didn't do any of that. Mortgage interest statement. So you can claim, actually we're not going to use this because a lot of this information I track, but you're not actually able to claim it if it's your personal residence. Just so you know that. These numbers you see here are somewhat of not really anything you care about too much. So I can't technically claim a lot of this information, seeing that it's a primary residence, because these are what I'm spending in life to be comfortable. So it's another comfort, it's another happiness. This is my house, I enjoy it. If I didn't want to pay taxes on it, I could live on the street. I track the remodel costs because once this does turn into an investment property, those remodel costs are depreciable, as well as the mortgage interest, mortgage insurance premiums. I'm not sure if I can back claim those as far as the previous years, but for the year in which you rented out, I believe you can. Check with your CPA. We're going to go down here to a good one. This one. All right, so what we have here is we have the gross rental income for this year. So I will show you exactly how you walk away from real estate, not paying a lot of taxes, but also still making money that year. So you have your gross rental income. That's how much I made this year from that property. This is how much a renter paid to be there. I have mortgage interest statement and the and the second mortgage interest statement. Oh, that's because that is because I actually had two mortgage companies. So if you don't know it, when you purchase a property, that mortgage company can take your loan and sell it to another company with as long as they keep the same paperwork involved or the same agreement with you, and they can sell it to a different company, and now you have two mortgage companies that you can claim the interest on that year. So mortgage interest statement, we'll go into that. Let me run over here to a different display. All right, so if we come up here, we're going to go to Rutherwood. Within this file, so I'll kind of like run you through the different things. We have the repairs that we did on the property. This year we paid total amount of, on repairs. We had quite a few repairs on this property. Kind of sucked, but it still made good positive cash flow. $2,653 for repairs. But actually we're not going to get into that. But anyway, we have repairs, cleaning and maintenance on the property. Insurance premiums. So the premiums on some insurances can be claimed, not guaranteed per state or per your situation. But sometimes your insurance premiums can be claimed because those are a business cost. Anything that the business is not giving you directly as a payment to you is tax deductible pretty much. If it's not coming to you and you're not able to spend it on the things you want in life that you draw enjoyment from, then that is probably going to be something that's tax deductible. So insurance premiums, legal and other professional fees, mortgage interest and insurance premiums. So this is actually something a little bit different. This is what I was going to get into earlier. So I'll pull this up. This is a tax statement that I get from the loan company on the property. And what it says is down here, there are a few things that you need to look out to. So if you have mortgage insurance, that is tax deductible on an investment property. So that would be right here. This property does not have any mortgage insurance that I'm paying currently on the loan. So it's not tax deductible. And I'm sure I mentioned this before, but if it's tax deductible, that means that they're going to deduct it from the income you made on the property, and therefore it's like you never made that income. Up here, the mortgage interest received. So you're paying for interest on the property. I paid $1,859 this year to a company to have for the interest that they charged me for the loan. But the amazing thing is did I really pay that amount? Not really, that full amount, because then when it comes to the end of the year and I have to pay taxes, if I claim this, then I'm not going to be paying that for my profits. This didn't come to me in a profit. I paid it out I might have gained rents and paid out money to to the loan provider. That money that went to the loan provider in interest is actually deductible off my taxes. So I'm not going to pay taxes on that. So there we go. You have the mortgage insurance premiums and you have the mortgage interest received. And that is it for this document, which is the 1098. Alrighty. Go back to here. Tax summary. Back to the tax summary. So that has to do with the mortgage interest statement. Utilities during remodel stage. So any period of time that the renters move out of the property and you have to go back in and you have to repair anything, that length of time that the renters are not renting your property and that it's sitting vacant, you can claim the utilities on the property. I believe if you're doing repairs on the property. I'm not positive on if you can claim the utilities if it's just sitting vacant, but there really shouldn't be utilities unless you don't shut off your utilities. But anyway, if you're working on the property while it's sitting vacant, then you can claim the utilities on that time period. Utilities during non-rented and repair periods. Sorry, I flipped these around a little bit, but that's actually utilities during the remodel stage. And then below us, the utilities during the rented and repair stage. They're pretty much the same thing, but I just separated them out so I knew what utilities I was paying during us remodeling it, and then the next year when we had to do some repairs on the property. That's the only thing I'm actually waiting on for my taxes is I had to contact all the utility companies and have them send me the statements, which is as easy as that. So you contact the utility companies, they send you the statement that you had on that address for that time period, and then you claim that on your taxes. Insurance premiums. There we go. There's the insurance premiums that I can claim to depreciate on my taxes because it's money that I'm paying back out in order to have that investment. Each property, it's a good way to look at this. Each property is a small business in its own, and that's how the government kind of looks at it. So it's a small business. That property is its own small business. Therefore, anything that property cost you is claimable. That isn't coming straight to you in profits. If you go below that, we have mortgage interest. This is the interest you paid on your loan. Underneath that, your taxes. Your taxes that your property is costing you, since it's an investment property, your taxes are tax deductible. So the money you pay for that property, the property taxes are actually going to be tax deductible because it's money you had to put back out to the business to pay. So you're not going to be getting charged taxes on that. Property management fee. So any management fees for a property manager, which I have, tax deductible. The remodel cost, tax deductible. So this property cost me $7,961.55 to remodel the property. That means that they're going to take that remodel cost, and since it's actually better this way, so they don't want to deduct it in 1 year, or you can choose to deduct it in 1 year, I think. But I don't know why you'd want to do that. I mean, there are reasons you want to do that. So you might have made a ton of money on the personal side of things. Maybe you made $300,000 that year in like gambling debts. All right, I'm getting into like some hot water here. There is a little bit of a different thing between gambling debts and stuff. So not gambling debts. Rephrase that. Not gambling debts. Gambling debts are seen differently in taxes. So let's say you made an extra $300,000 a year in bonuses from the work that you do, the company you work for. If you made that much, then you might want to claim all that on your taxes in 1 year. That way you can get a lot more down on those taxes. Remodel costs. So you can, what they're going to, a lot of the money that, at least the remodel cost and a lot of the money that you spent remodeling that property is going to be lumped together. CPAs are a little bit better at this. They're going to be lumped together, and then it's going to be divided up and split amongst 30 years. So it might have cost me $28,000 to remodel the property. I'm going to be that's going to be a deductible on my taxes over the course of 30 years. The same thing with up here. Any startup costs on real estate. So I paid this year. I'm paying I paid $4,397 for tools. But as of last year, since it was my first year as a business, I paid like $6,700. That's actually going to be divided up because it was a startup cost for the first year of business. Going to be divided up amongst 15 years of deduction. So that's going to be deducted over the next 15 years. Go back down to where we were. Property management fee, remodel cost. Like I said, cleaning and maintenance. I'm still not sure on this one. I thought I had some cleaners go in there and do some cleaning this year. I have to get the receipts for that because I'm not going to sit here and claim anything. I'm pretty sure I paid a good $400 to have that property cleaned at least once this year, or one of my properties, but I haven't found the receipts for that yet, so I'm not going to claim it. You want to claim things that you don't have receipts for? Good luck. I'm not going to get hurt in an audit because I don't want to. So date initially rented. These are things that I put on here for a specific reason because I actually built this primarily initially based on what CPAs actually use to do your taxes. It has a very specific list on there of what can be claimed or what is claimed. And I used that to build this list. And on there, they had date of initial rented. They also had days rented and days vacant that year. So that's what I put on there. Days for personal use. Advertising. Any advertising you do, deductible. Commissions. I'm not sure on that one. I'm not a CPA. So I put a not sure so that my CPA, I can talk to him and figure that one out. And the reason being is we're going to go into that right now. So, sorry, it's getting late and I'm tired. First thing I want to go into is the document in which states what specifically they're looking for to deduct on your real estate. So I'm actually going to go over that, and we're going to pull that up and look at that document specifically. So give me 1 second, and I will do that. Where are you? Taxes from last year. That's what we're looking up. So we're going to go into my taxes. We're going to go into past taxes. What the CPA is also going to want to see is your previous 3 years of taxes, so they can help build your case. A lot of times that's actually so that they can give they can get all the information that you're going to just dump on their desk. So they shouldn't need the past 3 years if you're not dumping a pile of information on their desk. But they're used to that, so they ask for the past 3 years. Here it is. I gotta get it to the spot that I want to show you guys because I don't want you to see all of my social security numbers and such, or I'll have to start this whole video over again, and I'll just not have as much heart into it the second time around because it's a long, information-packed video. And it might be silly, but I don't really know how to cut sections of video out, so I'm not that awesome at editing. Hope that doesn't hurt your ears. Here we go. Alright, no personal information. Alright, I'm about to show it. Display. Alright, here it is. You can deduct like I said, these rental properties are a small business in themselves. You can deduct the auto and travel per property, or you can deduct it per business. And that's okay. Cleaning and maintenance, commissions, insurance, legal and professional fees, management fees, mortgage interest paid to banks, other interests, repairs, supplies, taxes, utilities, all deductibles right on the form. Depreciation, so that's where they add up and do the depreciation, expense depth. So look at it here, this is amazing. So I did, just on the purchase of the property alone, just purchasing the property gives me a because this property, I really didn't remodel this property. I bought it and I rented it. It gives me a $3,199 depreciation every year that comes off of the income that I made from that property, just because of the purchase of it. Anyway, that's what I wanted to show you there. And now we're going to go back to a different screen. Back to the tax summary. So these are things that they had on there, so I listed them on here. Not really sure what they do with that information, but whatever. Other interest, 0. Contractor repairs. So we actually had a bunch of little problems with this property throughout the year. A lot of plumbing issues that we then later on took care of with our own work. But yeah, contractor repairs, all deductible. Supplies for the year, all deductible. First year of renting, not sure if deductible from closing costs. Closing disclosure attached. So here's the interesting part. And here's the part where I'm not positive. It gets really, really confusing for me, even as much as I've studied this. Property taxes, there. Prepaid interest, here. Mortgage points, there, right? What is all of this? This is the cost that it took me because I purchased this property and remodeled it and then started renting it out the next year. So this is the first year I've rented it. I think I can claim a lot of this in my taxes. To me, it seems reasonable that I should be claim a lot of this. And I'll explain right now what I mean by that. So these are actually things that I paid for in my closing costs at the purchase of the property. So it gets kind of confusing. And like I said, it's weedy for me. So I'm not telling you to do this. What I'm telling you is ask your CPA about it. When you close on a property, there are certain things that are deductible and there are certain things that are not deductible in the closing cost. That also depends on if you claim them all in 1 year, 2 years, or 3 years. It also depends on multiple other factors that a CPA will know that you just don't really have to know. But you can send him the numbers and he can figure that out for you. So what I'm going to do is I'm just going to step over to the closing disclosure form and kind of like step you through that and see if I can give you an idea on what you might want to bring to your CPA's attention. Primary residence. Where am I? Oh, these are my past taxes. Ugh, whoops. Yeah. Where is my closing? Just legal, professional, mortgage, insurance. Oh, yeah. All right. Here we go. Information for CPA. Ouch. There we go. Closing disclosure forms. Sounds like my daughter. No coming into the office. All right. So here we have, and look this over. I might have to cut some of that out too. We're going to go down through this together. So here we go. Points. I do believe, to the best of my ability, that these points are deductible. Pretty sure I've read that 100%. But don't trust me, ask your CPA. Your points. Now here's where my question is if I was not able to enjoy this money and it didn't come straight to me and I didn't use it to buy a new PS3. Wait, I don't play video games. I don't know what the newest one is. 10, 12, I don't know what it is. Back like 8 years ago it was a PS3. I don't know what it is. Since I'm not enjoying this money and I'm having to put it out into the market in order to make money off of it in my business, I feel like that should be claimable. I don't know. So we'll go through here and I will find out this year from my CPA. Underwriting fees. I don't know why that wouldn't be claimable. Appraisal fee. You have title electronic recording fee. You have all these other title fees. You have recording fees, city stamps. I went through and I did my best to see what was deductible. I went through websites, I read information, and it was confusing. Insurance premiums are supposedly deductible. Mortgage insurance premiums. Prepaid interest is deductible or normally deductible, but on closing costs, I don't know. Come down here. The real estate commissions. So I didn't pay any. The seller paid all real estate commissions in this one, but if I were to pay any commissions to my real estate agent, would those be deductible? It was a cost to purchase the house. It was a business expense for a reward, but it gets into the weeds, and real estate's a little bit different. I know on 2020, I was told that a lot of it was not deductible. So I'm going to re-ask about this information, and we will find out. I recommend you ask about it as well, because it can be thousands of dollars that you can deduct and or depreciate, whatever that. And good luck on that. So we're going to go back to tax summary. Yeah. I know this video is long. I hope you guys take a break because I can't. Oh, I'm not in the right one. There we go. Now it's moving. Anyway, that's right here. That's why I have this little disclaimer saying I'm not sure. All right. Pretty much same thing on all the rest of the properties, right? Same information, copy and paste, add it up, look it up. PDFs in which information is held. So that's all the information that I have. This is all the information I'm sending to my CPA. He's going to get all of this. And at the end of the day, he's going to use what he can use. He's going to talk to me about the rest and figure out what from there, right? But this is what I'm sending to my CPA exactly. The only things that I don't have on this document are the utilities that I'm missing, which he knows that, and these documents that I'm sending with it that are attached to it. And that's it. Everything else is here and lined out for him because I don't not trust CPAs. He's a great, awesome person, and I'm sure he does a great, awesome job. But I want to make sure that I'm covering all my bases and doing the best I can for my taxes. This is how the rich get out of taxes, how they say it. Not technically them getting out of taxes, it's just them doing what they can with taxes. They are using small business depreciating, or not depreciating, small business deductibles on everything from mileage to work trips to, I would imagine that you would really love a nice trip to France. And if you can say that you met up with some business associates there and you discuss business, that trip could be tax deductible, which means it wouldn't count towards your income. That's how it goes. That is, if you own a small business or real estate, then you're in the same place most rich people's tax, special taxing things that people say they have are. I wanted to go over one or two more things. Let me see. We're going to go back to the folders, and I just want to go through there and make sure I didn't miss anything that I wish I would have put in the video because I was not wanting to be thorough. All right, we have our real estate. We went through all the folders. Utilities, yep. Remodel costs, purchase. Oh, there we go. I'll just go through these. So within repairs, we have contract repairs or personal repairs. Within cleaning and maintenance, we would have cleaning and maintenance. Some of the simpler things. Insurance premiums. It's just insurance premiums. Legal fees, mortgage insurance premiums, that's all the same. Property management. Oh, there we go. That's the one I'm missing. So property management repair. So my property management sends me this, and it actually beautifully outlines everything I need almost. So I'm going to move over to this display. All right, here we have it. We have the rental income for that year. We have the management fees. We have all repairs done by the contractors that you brought in to do repairs. You have the owner's disbursement, and that's it. So this gives you a beautiful little display of what all the Remax Professionals. Yep. Gives you a really good display of what they give you. Oh man, I'm getting tired. It's dragging on. Vacant property. Okay, so that's that. Property taxes. Too easy to get. I just went to oklahomataxrolls.com, and that's where I find all my property taxes, as well as anybody else's property taxes. If I want to do estimates on their property, how much it's going to cost, how much the loan's going to be, and how much those taxes are going to cost me every year. And so most states have a similar website. Purchase. Nothing. All right. That is it. This was an extremely long video, but I hope that it truly outlined every single detail of what you're looking for to do your taxes this year in real estate. It's not easy. It's not perfect. And it's going to take a lot more research on you to actually do this right, but it's well worth it. Because at the end of the day, when people say, well, this is the reason I don't pay any taxes, this is the reason why they don't pay taxes. They're not paying taxes. They pay a lot of taxes. But they depreciate and deduct a lot of things that they shouldn't have to pay taxes on. And that's everybody. I mean, if everybody tracked every mile that they drove for work, every mile that they drove for medical, and everything that they spent that they weren't actually enjoying, and they claimed it against their taxes, and they actually knew tax law, then they could do all of this as well. It's just, it's laziness, and it's a lack of understanding and a lack of knowledge, and I hope that I brought some of that to you today, so that you can hopefully turn your life around and start doing much better. There was one more thing. Nah, whatever. I'll do that. All right. See you next time on the next video. All right. So I'm back at the end of the video. I actually remembered what I was trying to say. But I hope the video was really informative for you. Anyway, so here we go. What I remember to say is that one other things that you probably don't really understand about how taxes work and how the wealthy get to do what they get to do with the tax they have. So something you can do that you maybe don't see as of yet is once you get into the business world, you can do anything. And real estate's kind of the key to get there. So real estate's one of the easiest means of getting passive income in order to set yourself on a path that you can choose what you want to do. So the wealthy and the rich people, they reach a state in which they don't necessarily need to stay focused every day working on the task at hand. They have passive income, they have extra time and extra ability. They also have the capital to fund different ventures that they want. So let's say that you've always had a passion for scuba diving, and you just love it. You've checked it out, and you really want to scuba dive all the time. Well, if you have the funds and the means, you can start your own scuba school. You can start your own scuba diving team. You can start a treasure hunting team in Florida. You can start your own treasure hunting company where you buy and sell, gear. The world opens up to you in many ways that allow you to do what you want to do, when you want to do it, how you want to do it, in the form of a business that's making money and that's paying employees. And in that way, your life becomes a business. Your enjoyment, your time, your passions, they can all be part of businesses and companies in which you produce and grow. Your travel now becomes business expenses because you're going to see these other countries and you're spending time there, but you're also doing business over there. You're buying real estate over there. You're owning real estate in these beautiful areas, the Bahamas. Yeah, we'll go to real estate. I can buy real estate in the Bahamas. You can buy real estate in Florida. You can buy real estate in California. Buy real estate where you want to live. And now you have those homes that the rich and wealthy people all have throughout the world. When the home is vacant, it can be sublet out to short-term rental. The property can make income while you're not using it. And then when you want to use it, you just choose your time you want to be there. Nobody else gets to be there. Now you have 4 vacation homes, and none of them cost you money. They only make you money. And they save you on taxes every year. Because as you saw in the video, you're not paying those taxes. They're being paid through other means. Another thing I want to mention. Rich people got limos, rich people got assistants. Rich people have, all these things that people, they like to groan and complain about, but then they also like to say, well, I'd never want to be rich. Well, it's not about that. It's about freedom. And a lot of times they have freedom. And just because you say you wouldn't want it, then why are you complaining about it? So that's just another means in which they use to open up their life. If you want to travel and have adventure, they video and travel and spread their adventure to the world and then get paid through YouTube in order to make those videos. That's how wealthy people do it. They're creating a lifestyle that pays them. And that's the last thing I wanted to put on this video. I hope it was super informative. I hope you learned a lot, and I hope to see you one day growing and doing great things.